Okay, guys, we're going to go to the Answers Hub tonight. And it's a question from Stuart, so it's a little salute to you, kid. And it's about staging of trades. Now, it's kind of complicated, but I'll water it down best I can. So let's roll the intro, and I'll tell you all about it. And a warm welcome, one and all. So let me flick over into Discord and the charts so I can show you what this is all about. Yes, it's bank holiday, so it's pizza, fire. Who on earth has the fire on in August? It's freezing where I live. Anyway, got the beer, which is cold. Brilliant. Joanne's happy as Larry because Jason Stretham's on as well, watching the mechanic tonight. Anyway, get down into the Answers Hub. And as you can see, we go through various different questions that we ask. Now, as we go down, it's this one here. So another salute to Stuart. Well done. Great video on Madness. Now, Madness is a management system of the trade. It's actually where the money's made for me. Now, on that, I was mentioning about forward staging, reverse staging, and things like that. And the question is forward staging better to commodities or position stroke swing trading? I was wondering why some would trade forwards rather than backwards when not day trading. It's a great question, and it's a question that, well, let me just put it this way. It's about time scales. For me, forward staging, if you're day trading, is suicide. It really is. And you're constantly told, add to winners, add to winners, never add to losers. There's some truth in that, but not for a day trader. For a day trader, it's stupid. Now, think of it this way. If you're going into market, in the last 100 trades, how many of them went for you straight away, out the gate, and straight to target? Be honest, drop it in the comments and tell me, how many out of 100 can you do it? And I don't mean once in a blue moon, I mean consistently, day in, day out, for years. I've done this for 20 years nearly. And I can't do it. A lot of what I do, I get the entry wrong. So what I do is I stage backwards to get a better price, and then it'll move forward for me. Now, if I try to add to that trade, by the time the trade needs a second adding in, the chances are it's on a return, and I'll give away the profit that I had. So for day trading, forward staging is, let's just call it problematic, and then I'll show you how to do it properly. Now, if I go back to the chart, if you're day trading, a lot of people are on 5-minute charts. So let's take a day sample of a product that we all trade, cable. Everybody trades it. It's one of the majors that is traded globally day in, day out. Well, let's see where 8 o'clock is. Start of a trading day is here. It's the current chart. I don't do rollback charts, guys. I always do current charts. There's the end of the day. How could you stage into that? You can't. It's a sideways market, and it's like this all the time. Pushes up, pushes back down. So if you came in here and you were going long, yeah, you're going to get your nice long trades in. But you've got no opportunities to really stage into this to let the trades run. So inevitably what happens is you try and hold on the trade, as you can see here, and you're pushing up, and then it just comes back to where you started. Even if you were going this way down, you can't stage going short either, comes back to where you started. This is what happens on a 5-minute chart. It's too condensed. Once in a blue moon, it'll run for you. And if you ever look at the statistics, it only ever trends about 30% of the time. The rest of the time, it's like this. It's just working its way through, and then tomorrow it'll step up a little bit and then work its way through and then up the next day. But throughout the day, this is what you get. But let's look at a day. So that kind of illustrates why I wouldn't stage forward. But if I'm looking for 10, 15 pips, you know, and I'm getting in here, I could stage backwards and get my 10 pips by just going bum, 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 and then up by breaking my position up, okay? But let's look at the daily. Now this is a different kettle of fish. Same chart, different time scale. Now if I'm looking to trade this over multiple days and months, like a position trade, then yes, you can stage forward with it. But there's certain things that you do. Now we're looking at this wave pattern here. Now if you're familiar with ABC patterns, Elliott wave, all of that sort of thing, you'll be able to recognize these things. Now you combine that with Fibonacci, that'll give you a good opportunity. So we can recognize there's a start here, and say you start trading in and around this area, just for argument's sake, and you are expecting the market to keep on pushing up. Well, you need it to top out. So where's it topped out? Well, it kind of topped out here. This candle gave you a signal. You could sort of say it was this one as well, but let's have a little look at a retracement. So you can see it's come down there. We said we started sort of on that overextended candle. Came up to this point, but it never broke the 23. So therefore it couldn't lock in. It hasn't hit a key Fibonacci level. You need to get it to a point where it does lock in, which would be there. Why? Because it broke through a key level. Right, so that's your first leg of an ABC pattern. Okay, how do we know? See the start, see the end, and we see a locking point. It's locked in. Okay. What else can we take from this? Well, you can also take that you still believe the trade is going long. So you can stage into this forwards. In other words, you're expecting it to go in the way that it's going, but you could also add into it some backward staging as well to get the best of both worlds. So you've entered your trade, it's pulled back. That means you can look to enter through the key areas. I'll just change these to blue, just so they stand out a little bit. So you've got one there. You've got another entry point here, and then you can have another one sitting on the 50, and you could actually have it down onto the 76 because they're the next two key. If it goes back to 100 and breaks 100, the ABC patterns, etc., they've failed. Okay, so you can enter into the trade 3 more times here, adding up into the position as it moves forward. How far do you think this might move? Well, you can use your Fibonacci again. You go from here to the high because you're now expecting this ABC pattern to play out, but you want to see where it's going. Well, there's a key area, which is there, and the next one is directly above it. Look how the chart has played out to the single leg that we've identified. Turned on the pip, and it's stalling pretty much on the other one. Okay, so all we need to do now is draw in our wave pattern. We've got the first wave identified. There's our added extra. How do we add into this lot up here over multiple days? Well, it's very simple. You now put your wave on. So you put your Elliott wave on. You can see where it started down there. We know it got up to here, giving us position 1. Down to the low point, position 2. So what else can it do? Well, we've already identified where the 127 is because we got that from the first leg. So that comes up to here. So you know in and around here is going to be the 3rd position. So you would just put it to there, and then you would draw another Fibonacci on this, and you work on the pivot point, which is the 50. Now let me draw that in for you. So again, up to there, you've got a pivot point, which is the 50, and you would draw a zone in and around where that is. So it got down as far as here, but if you were working it out to try and work it out, you would say roughly that is the next point. Once it's formed, you can move it further down, but at the meantime, you can just put it on the 50, just like so, and then look to see where the expansion is of that 50. Well, the expansion is here. So we know where it started, which is there. We've now got a definitive top up there. Pull it back across, and the 127 is highlighting roughly where this is. So there you go. There's your fulfillment. So now what you've done, before this last move comes in, you've kind of worked out roughly how to get up into this area for the fifth wave. And why there? Well, because it's the expansion of this. And then how do you get up to there? Well, you drop your fib onto this again, just like so, up to there. And once it's broke through that 23, there's your new staging points. Just under there. And you put them in. And you take it back down to 76. And that's roughly where it gone. It was really deep. And then off to the races up to that 127. And it's becoming a new key turning point. So that's kind of a watered version of using ABC patterns, etc., but using them to kind of map the chart out to where you could logically put in extra orders moving forward. Now, the other way of doing this, if I just strip all of this down, is you wait for the identification of each leg. So the identification of each leg, as we said before, is a locking point. So there's a retracement. So it's there, locked in here. So what you're doing is you then put your orders here, because that's a key level, and it'll stay in place, you know, because Fibonacci's do. You've got a key level here, and then you've got another one there. Don't need to go much further than that because you saw it run through and break. Okay, this leg can also help us identify the top of here. So we just do that. Extension. So we know that's the top and we know that's there. So when the price gets to this area, we kind of half expect some form of a reversal. Okay, so it does reverse. We put a new fib in. So we can see where it started. We can see where it ended. Up there. We're waiting for it to break the 23. So you can now enter here. Here. And here. We've already got levels here that you can work with. And then again, you're building it up. Put your extension on to move it forward. Back to where it started. And then there you go. You're working up to there. And then an Elliott wave works in 5 phases. 1, 2, 3, 4, 5. That's where you get out. And in the meantime, you are buying every single one of these till you get to that 5th point. So that's kind of a way of looking at the charts and how to map things out. I try to make that as watered as I can. It's quite a, I was going to call it a complicated system. It's not, once you've got the first leg in. Because once you've got the first leg in and it's locked in and you still believe that market is moving forward, then you can work out roughly where the next turning points are on logical Fibonacci ratios. And then you can just buy back into the market or sell it if it's going the other way at these key points to build your trade forward. it only really works on high time frames. You can't do it on small time frames because you've got spreads involved, and then you've just got the natural movement of the market. It often comes back to where it tests before it moves up. Now on a daily chart and a 4-hour chart, those moves are quite substantial. So by the time it pulls back, it isn't really getting into the start of the day. It's a couple of days on, which will have naturally moved the market. But trying to do it inside a single day, it normally comes and takes you out. So I hope that helps. Do put your comments in. I answer every single one of them personally. And as always, guys, do what you love and the money will follow. See you all in the next one.